Man, I wish we'd have had that. We kind of do already have it. Did you hit that one going already? Thank you, sir. Appreciate you. Yeah, Will here in the office is great. Big help to me. All right. So your opinion then is that the CD sisters example is more of a preface of equipment finance.
Yeah. So he's laying the groundwork. I think it's page 45, it's table one, um, where he goes through like the comparison of D and E. I think they rule out the other ones by nature.
Hmm.
You're left with really kind of, should I save in a CD, or you could replace that with money market. You could replace it with like all the high yield savings, all the stuff you hear on TikTok. Well, why don't we just do this? Like
Yep.
he addressed it. If you would have read the book and studied it, he addressed it. um, but he'll go through it and like some very common mistakes. You'll see people compare one column to the other and say, that number is bigger, so it must be ahead. Very simplistic view here. A lot of really big names will make that mistake. They'll say, cash on this year. This one's winning, that one's losing. Look at this. I don't know if you're turning to that page or what, but if you went to row 8 with the first loan, well, first let's talk about, he calls it deposits because he's talking about the CD at the bank. You could also say premium payments. He mirrored the premium payments, so 5,000 going to a policy for 7 years. He picked 5,000 because it should be underwhelming. It wasn't supposed to blow someone out of their like out of the water like equipment financing at 40,000 a clip. 5,000 is doable. It's like the Roth contribution, the IRA contribution. People do that regularly.
Yep.
So anyway, um, on column, I'm sorry, row 8. Yeah, let me actually pull this up so I'm not giving you bad info. Here we go. Here we go. Okay. So I'll give away some stuff right away. Like we back up. Oh, not that far. Back to table one. Okay, so at the top here, if we zoom in, you can see I wrote some notes here.
Hmm.
This is the consumer mindset and someone who migrates to an owner mindset. These are some details about the CD, what it pays roughly at that period of time. The note that they take out is about 8.5%. It's surprisingly close to what we have today. Um, a couple little things I wrote here, going back to when he was saying two people can buy the one car right off the lot, right off the factory belt to the other one. One gets 50,000, the other gets 500. And I just kind of put out of the deposits. So they both did the same thing. The end result though is very different. If we This lets me scroll down a little bit, you can kind of see the retirement income. It
Right.
only lasts
The
five
bigger
and
picture,
right, the
actually
bigger
thinking long range.
exactly. Um, Meanwhile, the difference being plus 700,000, the delta of the two, if you would have used your policy long range. The risk, the net cost of this after year one, like remember, you only paid 5,000 for 7 years plus interest. It was about $50,000 total cost. So in year one, year two, you've received all your money back out, all the cost basis. So it's a net zero cost over the course of your entire life or 50 years. You've pulled how much out of this thing, right? The death
Significantly more.
significantly more. They only got 5.5 years, 5.8, 5 years, 8 months of income. You got till 65. You got this death benefit lingering still. Scrolling back up, the big difference I see, people will say, oh, the break even might have been, I think it was 50, 15, they would say 16 maybe. Hey, that's finally when the IBC method here at 59 something and then 58 something. They're like, oh, look, you finally broke even. 15 years later, why would we do that? It's like, well, take a look at the first loan, the first time you actually use the policy. What's the difference after you've paid it back? That grew 14, that grew 16. So if we're looking at this at the platform, you are much better off starting in year 8, not 16, because we're using it for banking. We're not looking at the actual number, the balance. When you look at the balance, you're kind of, how would you say that? It's you're looking at it as a single use product. It's kind of the way your account and all other accounts that can't be collateralized. It's single use. So the balance is the most important thing. When this is revolving, it's like you want the delta of when you start it from when you end it. That's the thing that matters. This actually broke even much earlier, even though the number is smaller. Like the efficiency of your dollars over here is much larger at the first loan. Um, yeah, I thought this was.
So let's do this. Let me share some thoughts with what you're describing so far to conceptually discuss, what's on my mind based off of what we're looking at right there. If this is where the conversation is going, I feel a few different themes. Here's one thing. When people are considering this infinite banking concept, rate of return is a common theme or question, right? Passive income is going to be another common theme or question. What else did I just have cross my mind? Of course, first and foremost, really, banking itself, which still kind of ties into passive income, obviously, because that's finance, and it still ties into investments or rate of return because those are financed. So here's what I'm saying. For the average American who's out there in the wide world, who's either running their business or pursuing their career, conventionally they're told to look at some of the things that you've mentioned already, like an IRA, a 401k. You need to put 5,000 here. You need to put 5,000 there. You need to get a good rate of return. This is what the S&P 500 has averaged, etc. Hey, you need to be saving for retirement. They'll use that language. Sometimes even instead of actually saying investing for retirement, because those are two big different things. So maybe I'll even write down savings versus investing is a relevant theme right here. And just like you were describing in looking at these charts, someone who's trying to pick at infinite banking will go to some early year and not consider someone's whole lifetime to say, well, see, look there. This isn't doing what they say it's going to do or what it should do, or you could be doing better over here. Again, in retirement plans, investments, etc. So I don't know. These are just the themes that you're making me think of that merit a conversation about the concepts, and then also you continuing to do exactly what you're doing, looking here in the Becoming Your Own Banker book at this comparison to pointing out the mathematical or the numerical side of these concepts. So I don't know which one of those you want to tackle. And I wasn't trying to interrupt you, but you were just crowding my mind with all these different conversations about rate of return and what people conventionally, and I don't know where you want to go in this conversation, Joe. You can go wherever you want. I don't know if we're going to be talking just to people who are already implementing infinite banking or people who are still vetting it, but these concepts, these subjects are still relevant for everybody. Rate of return, passive income, banking in general, savings versus investing. So I'm just sharing my thoughts about what you've been making me think about. But that one point, I'll end on this one point and then it's back to you. Nelson's number one principle of think long range is very important. And the more I'm alive, the more I realize how important that is, that we should be considering what is possible over the course of our lifetime, and then ultimately what we can do for the next generation as well, which could be its own additional subject. All right, so keep going.
Yeah. So I wanted to, I started formulating an order as you were saying that. The first thing I would address is probably, we're taught to look at balances, your balance sheet, right? In personal finance, that's what we're taught. That's the most important thing. Your nest egg gets to a critical mass, you're fine. The idea is to amass a large balance sheet, a large net worth. That's personal finance's goal at the end of the day. You need a large enough balance sheet to support your lifestyle later. When ironically, the more like personal finance is a young sport. It's only been around 75 years, something to that effect. It's not hundreds of years old. Something like corporate finance is significantly older, or accounting significantly older, banking significantly older.
Okay, so what do you mean then when you say personal finance? How would you define that or categorize that or describe it?
Traditional, like you go to a CFP professional, they're going to talk to you about what you should do with your money. They're going to apply a framework that is supposed to work for the person and the household, but they treat it differently than a business would. So we're going to distinguish corporate finance and personal finance. We missed a step here, not we, but the industry, and why they thought to deviate from corporate finance. Corporate finance works and it's extremely profitable. If you think about the goal of any corporation, to generate profit, it's not a balance sheet. It's cash flow. They want more operating income. They want more revenue. They want more profit. In personal finance, they want a large balance sheet. They want a large balance. They want a large net worth. In corporate finance, they make prudent decisions with all capital. They recognize all capital has a cost. They think through methodically and take small risks for outsized returns. They don't gamble the farm for a small return or really risky. In personal finance, we're regularly told, just put it in the S&P 500 and walk away. Just put all of your capital into this marketplace of stocks and bonds, and when you get to retirement, you'll be a multi-millionaire. See, look what my calculator tells me. If you apply that logic to this table and you apply personal finance is going to compare balances and say, oh, look, this balance bigger number better. Bigger number sooner better. It's Ryan Griggs saying. If you look at the cash flows, you're going to notice, oh, wait, it's not that column. It's the other column, the infinite banking concept. If you look at the bottom, they have a bigger balance a lot of the years until 15, 16 years in. But at the bottom, does it generate enough cash flow? No. Does it leave anything for the inheritance or then the generation 2 of the business structure? No. Right? It's very single-minded. It's you're playing a finite game versus an infinite game. The infinite game meaning the business is supposed to carry on. When I disappear, that's okay. It's going to keep carrying on with this mission. In personal finance, it's, hey, you're going to work for 30 years or 20 years, save up, and then spend it to zero, maybe leave something for the kids, and that's it. Like that's generally the advice. And it's like, wow, that's not, if we took a long-term approach, which is what Nelson was saying, if we took the infinite game approach, if we took the corporate finance methodologies, all of a sudden our focus becomes, how do we generate cash flow? Everyone says cash is king. It's like, cash just sitting there means nothing.
Right. Let me ask you some questions there, if I can.
Go for it.
So two things. Let me say something real quick about, I think there's a lot when making a comparison to consider other than just what some people would call the bottom line, like you're talking about, looking at, okay, well, the CD is earning this while the infinite banking style policy is doing this in this year or that year or the other year, and what's the number? And that be the only part. So you and I both know that, well, there are a lot of characteristics to a policy that a CD or insert any other thing is not going to have. It's not going to have the death benefit. It's not going to have the tax-free access to leverage a value while still compounding that value. It's not going to have a hedge against inflation at the further you go out, and you see that these dollars are creating multiples of themselves in the future, and all those different characteristics that you get with the properly structured whole life policy versus whatever else. So if I put a pin in that for the moment, I'd like you to go back and talk more about these differences between, because this is what I think would maybe help people. I feel like it's helped me understand these differences better as a layperson between the personal finance and the corporate finance, like you were just talking about. So more on the personal finance real quick. What do you think is the biggest contributor to someone's personal finance potential trajectory? What aspect? I don't know. I hope I'm asking that right. I think I know what I would say, but I'm trying to ask you the question first. What's the biggest contributor to someone's potential personal finance trajectory?
Well, I think, I mean, without sounding cliche, I think it starts with mindset.
Okay.
The very start is to be able to identify that there's two. Do you mind if I share my screen? I'll show.
Yep. No, share your screen anytime you want. But when you talk extensively, I do like being able to see you full screen. Yeah, share anything you'd like.
This is, hopefully you can see that. I don't know if, there we go. So,
and I agree with you, by the way. I guess when I asked that question about what do you think is the biggest contributor, I was thinking, okay, tactically, but I think your answer is more appropriate, because as a man thinketh, so is he. So yeah, I was thinking more tactical. So I'll come back to it, but tell me what's on your mind here.
Yeah. So I think the two methodology, we're comparing the two. We can create a comparison. Businesses, they use liabilities to purchase assets that generate revenue, pay the expenses of the liability, and still leave extra for you afterwards. Okay. Personal finance uses liabilities to pay expenses and eats up income to pay back the liability. And whatever's left, they try and buy assets with. So the order of operations is like reversed or out of whack with personal finance. They say pay everybody else first, and you get the peanuts that are left. Now, to exactly what you said, a man thinketh, so he should act. I believe the act of choosing where you put your dollars, choosing where your cash flow goes, is the start of the problem. So it's thinking and that choice. You can buy, expenses, or rich dad poor dad call them doodads. You buy liabilities, buy expenses, but the reality is, if you can think to direct your cash flow to something that will enrich your family's financial well-being, you will be infinitely better off than someone that follows the other methodology. Like if they are paying themselves last and they pay themselves whatever's left, and they're trying to squeeze that little bit, I'm going to get 10 or the Dave Ramsey 12% every year. It's like you're never going to catch up to somebody who directs a larger volume of their money to something that's feeding their financial system. Never. If you're buying productive assets, that's what businesses do. They go out and they acquire productive assets or productive entities. The reason they spend is to generate income. It all comes back to the capital. They're trying to net something at the end. That's their capital that gets pushed back onto their balance sheet.
The money is used to make more money.
Yeah. Money at work. Personal finance, they put the last dollar, whatever's left, to work. And everyone's like under a microscope looking at that dollar and saying, "Oh man, if we could stretch it a little bit more, look how much better off we'll be." Um, it's much easier to add more dollars to the pot. I always use like a horse race as a way to compare this. One methodology, you're trying to pick the winning horse, and you're constantly trading one horse to the other. So you can put money in your savings, but then you got to take it out to put it in your Roth, or take it out to put it in a brokerage account. So you lost that horse, and now you have this horse. Like, whereas if you just have more horses, you you have a much better probability of winning.
Start a breeding program.
Exactly.
Kind of like we referenced the. It makes me think in our last conversation we referenced "It's a Wonderful Life" and those $2. You know, right there at the end there said, "All right, go make bunches of babies." All right,
Mommy dollar, daddy dollar.
right, exactly.
Oh man.
Okay, so let me go back to one of the first things that I noticed from what the conversation started out, where people don't naturally tend to look long range. So here's something that I heard and thought about some from listening this week was how corporations, how many names of companies do we know that have been around longer than we've been alive, you and I, Joe, and they're probably still going to be here when we are gone. So that's where I see that number one principle from Nash of, well, think long range. If corporations, are prioritizing cash flow, and if they're prioritizing assets, and if they're prioritizing, their capital and how that capital could be used to start this breeding program, or if we're still talking about horses or whatever, where the money's making more money, they have a really long view. Right? The successful ones, all the ones that if we named them, everybody would know. They've been here before us. They'll probably be here after us. Think long range. People should be thinking long range and not just looking at, well, what's this going to do in year 1, year 7, the longer range we think, the better we're going to see the bigger picture, obviously. Except we got to be told, we still got to say that out loud because Nash did, it's important.
Wow. The long range. So I love where you're going with that, and I think I like to mimic the most profitable, the longest, most secure industries rather than just any company. Because what you said could be an argument. One could argue that is, well, that's why I buy the S&P 500. They think long range. I don't have to. Which, in my opinion, I think delegating and separating yourself from the capital, I don't think people understand how much they give up in return. It'd be one thing if they owned the company and were sitting at the table making decisions. They would make a
Yeah.
lot more than you investing with a broker in a mutual fund that has a fund manager that buys the shares of the right. You're like 12th in line. And we're not even talking like when you get a profit, then you got to pay federal, state, local, social security. Now you got that little nickel that's left and you're throwing a parade.
And that's a wild thing, isn't it? To talk with a business owner, let's say, because I'll talk with business owners and they might be wanting to talk about, real estate or just whatever it is that they want to talk about. And they're not already in that space. And yet daily, weekly, monthly, they own their own business. I think that's wild. And so, and maybe it's because we're told to diversify, right? That a business owner would think about taking their capital that they produce from their own business to go put in somebody else's business. And maybe they should. I'm not giving advice. I'm not telling people what to do. But I think that it's interesting that people will jump right over how to grow and scale and improve their business by sending capital somewhere else where they don't have the same level of control. Like you were talking about, they're not sitting at that kitchen table making those decisions.
Diversification, Charlie Munger said this, and I'll make it a small adaptation to it. Like he would say, diversification is insurance against stupidity. Is for
Okay.
people who don't know how to assess, they can't or don't know how to assess which investment, which asset has the highest return on capital. So for the business owner to not invest in their company, like imagine if they were trying to sell their company and they're like, hey, you just generated $1 million of profit this year. You have a choice of putting that back in your company or give it to a bunch of other companies.
Right.
And right before you sell, you're like, hey, I took the money and gave it to somebody else because I think they'll do better. Now you, the buyer, is going to say, well, whoa. Why am I buying this business then? It kind of it's if you really slow down and think about it, it doesn't make sense.
They're not even
When
betting
you
on
can,
themselves.
they're not betting on themselves.
Or maybe instead of using the word betting, maybe I should say they're not even banking on themselves. That way I got a little play on words going on.
I like it. But that's what, like, you'll notice why when high level CEO such and such level people in S&P 500 stop, when they sell, there's people that monitor that and say, whoa, insiders selling, what's going on? Everyone gets in a panic when they see hundreds of millions of dollars or hundreds of thousands of shares being sold at a time. They're like, these guys know something we don't. They're getting out. Why would I buy that? So it does have multiple layers if you actually think through it. If you own a business and you're 10 years in generating millions of dollars of revenue and hundreds of thousands of dollars of operating income, why would you not invest in your business that you have absolute control over? Yeah, again, the idea of diversification, it's easier to sell that way. It's like, hey, it's easier to say, I don't know, so let's invest in everything. That's not actually investing. Investing takes discernment and focus, right?
It's more
like,
speculating, like you said.
Yeah,
speculating, like you said before.
Yeah, it's just, it's again, it comes back to you not being able to see where the highest return of capital goes. So you just give it to everybody and hope somebody out there is going to return the capital enough that the people that don't return it or lose it or it covers everything. That's what you're betting. It's still a bet. Diversification is not safe.
Right.
You're betting.
Right. So let me ask you this, because I know that plenty of people that'll be listening to us are going to be working for themselves. They are going to be, a solopreneur. They are building their own business. They're a one-man show. Some people, they're going to have a crew or team or whatever. And then there are folks that are just in a field, in a job, in a career, and they're pursuing that, right? So if they don't have a business that they should consider, paying more attention to and putting their money where their mouth is, right? What would you say then for that layperson who does want to do something because they don't have a business to put the money in, and maybe they should consider a business, pursue whatever business would facilitate, other passions and interests, experience, etc., that they have. Like I was just talking with a truck driver yesterday, been in that field as a driver, right? Having the job for decades, but has this business model that she's ready to launch, that she will own and she will operate to provide a dispatch service for. So it's a connected, it's a part of that field, but it'll be a business, won't be a job, So maybe people should consider, a business if that suits them. But what else do you think folks should consider otherwise?
I got two thoughts there. I want to, since we were talking business, I want to address that one first, and then I'll back up and go to the person. Business scaling. Like imagine this person. What went through their head when they're driving, right? If you own a small business and you're just driving for yourself, delivering such and such, when you have more capital that you can control, you have more opportunity, and better opportunities will seek you out the more capital you have. Okay, it's like a magnet. And you're able to think abundantly. You're driving, maybe you leased your truck. So the first logical choice would be, man, my business would immediately get more profitable if I controlled the lease. or I finance the truck, I control that. So maybe that's the first step. And then you think to yourself, well, if I did one, I might as well have two and hire somebody. So then you hire another truck driver. And then you start thinking, well, this isn't, recession proof, but if we own the dispatcher, then we've got layers of diversification within a concentration. You're buying your vertical, right? A vertical is like the supply chain of how it got to you.
Yeah.
So now you got the dispatcher. And then you're like, well, we got the dispatcher. We got this. We got economies of scale. We've got capital. Why don't we start opening stores and selling the things that other people are telling us to ship? So now you kind of create your own demand, right? And you can see how this can very easily become a huge operation. Like, I don't know, that sounds a lot like Amazon, what they did. Like, they have so much economy of scale. They buy so much in so bulk that their cost goes to zero. They can virtually put anyone out of business. You can't do that by buying a mutual fund. You
Right.
can't do, like, the business owner. This is the freedom to think bigger. It's the freedom, and maybe you don't want to do that, but maybe, when you buy your vertical, there's more certainty in that than there is in just throwing money against, like spaghetti against the wall. Diversification for the sake of diversifying and diversifying. Like, I don't, it sounds more like a cop out, an easy way for people to sell a concept than it is actually helping the client. The business owner will always get the highest return on capital by reinvesting. If they can find ways to reinvest and amplify their business, it helps them now, it helps their future cash flow, it helps their exit when they sell, if they want to sell. There's so many layers that it helps. Or the alternative is give that money to an ETF or a fund manager or an advisor.
Right.
Pales in comparison. By my multiples, it compares.
For sure.
And I've seen that.
You know.
I have clients that they have the 9 to 5 that they work Monday through Friday, et cetera, or whatever, but then they break into some field or some space where they have experience or connections or knowledge or skills or what have you, passion, and they're building that as a side business along the way, and the side business can become really substantial, of course, because they, with me, are using their private banking system as their warehouse of wealth. That's their private and their business banking system that they use to capitalize what it is that they're doing in the business world. Oh, it's a lot of fun to have those calls where somebody says, "Well, I bought another truck from my system." I bought my 3rd truck, and stuff like that. It's a lot of fun. So good. And when you were giving that one example, I thought of Jim Rohn. Like when you were talking about, well, if I got 1 truck, what's 2 trucks like? Because I got boys, I got children, and my boys are. And I remember Jim Rohn saying sometime about, well, teach a kid not just to get a bike, teach him to get 2. That way, he's got 1 to ride and he's got 1 to rent out. And I thought, man, what a, I wasn't thinking about that kind of stuff, when I was a kid. But what a neat thing, to think about, which I think also goes back to the first thing you said, which is mindset. I didn't think that way as a kid. I do think that way now. And you and I have an opportunity, of course, and that's why we're having conversations like this, to be able to share these thoughts earlier with, our children or family or clients or anybody that's going to listen to this. You know what I'm saying? So me and my home, yeah, it'd be a great idea for me to encourage my boys. Hey, how fun is it riding that bike? It's a lot of fun, isn't it? Popping that wheelie. That's awesome. Okay. What if you got a second one, right? And somebody else could have that kind of fun, but it's your bike. You own it, right? They could pay you to be able to use that. You're helping them because they don't have to go out and buy their own bike, but they could use it that day. Or just so, and then of course, all the way to the conversations with clients to where, yeah, they've started this side business and they got their first truck, right? And then now they're growing and scaling, getting more of that vertical, like you were saying. It looked like you had a thought too. What'd you think of right there when I was saying that?
I was just, so let's pivot back to the average person. The 2 things that came to mind when you were talking that, the average person, the book is written, Becoming Your Own Banker is written for the average American family.
Yep.
This
People
isn't
like I
for
would.
the average person. It's only for people that make X. They didn't read the book. They didn't study the book. They're not a student of the book. They're not rethinking their thinking. They're approaching it like, you got to start here. And it's they didn't spend enough time in the book. The second thing that came to mind was each person's unique. I have no idea, and it would be incredibly arrogant for me to tell you, Mr. or Mrs. C-suite person or professional person, I don't know what you're good at. I don't know what your skills are. I don't know what your unique idiosyncrasies and competitive advantages are. I don't know. That's part of the beauty of this. You've got a guy in there who's your audio video whiz. He could use this concept if he wanted to start a massive audio video type enterprise if he wanted. Or he doesn't have to. He could just not use a bank and buy his car through his policy. The choice is yours, and that's the beauty of it. You're in absolute control.
For the record,
If
I
you
don't
want to
want to
make
cut
it-
in on you. Keep going, but I have had a podcast episode with Will, and he does do some pretty cool stuff. So everybody that's listening should check out that episode. All right, keep going. Sorry.
That's the whole point. The whole point is freedom. This represents a degree of freedom that the very nature of the personal finance model is you, Mr. or Mrs. Client, have to put yourself in a box. You have to divulge what your goals are. Goal 1, 2, 3, 4. Once you declare those, it goes into a formula, and the advisor is going to say, put money here, 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 and here. Wherever they tell you to put the money, it's not nearly as flexible. You don't have any control. There's very little guarantees. It's like you're hoping to hit your goals. Like if you don't, they give you 3 options or maybe 4 options. I forget. Like work more, save more, spend, like lower your goal. When you get to your goal and maybe you're missing the mark, that's what they tell you. Like, well, Mr. or Mrs. Client, we didn't do as well as we thought, so you have to work 5 extra years. Or
Yep.
we can do half the goal. It's like, what? I trusted you for 20 years and I'm off the mark. So it's just a different philosophy. It's like you're building on solid foundation that you have as much control, contractual control, as you can get. Like there's nothing else that gives you this level of control.
Here's what everybody that you just described that's in that boat, right? They're in that job, they're in that career, they're doing all the conventional things. While they are perhaps saying, well, I'm just going to send my money over here to this person, hoping and prayer, right? Or they'll say whatever that they will about anything financial. If they're just doing that conventional route, they're overlooking what we are all doing, which is driving cars, taking vacations, buying medications, saving to send our children to college or to pay for their wedding, or all the things that we are doing now anyway, and we just don't look at that and say, well, that's actually financed. I'm either paying credit or paying cash for that, right? And if they're going the credit route, they're asking somebody else's permission to buy their cars, right? To pay for their kids' weddings, etc., and then paying them interest for it if they approve them after the paperwork, etc. Or they are proactively trying to do well for themselves and they're setting aside the cash for the wedding, for the vacation, for the, the braces or whatever it is. And then that money gets spent that one time and it does that one job and it's done. So I ask people this often, and I say, this is not a trick question. And I'll repeat it. This is not a trick question. If you take money from your pocket, from your paycheck every Friday or wherever, and you go out and do the thing that you just told me that you're going to do, and it's whatever it is, right? Like, hey, I want to take me and my sister and my aunt on a vacation this upcoming April. We're going to do this, that. Awesome. Great. That's your plan that you're going to do that. Okay, you only got 2 options to do that. If you take that money out of your pocket and pay for that, how many jobs did those dollars accomplish for you? How many tasks did the literal dollars do? And they'll think about it for a while. And sometimes they'll say none. And I'm like, well, no, it still does the one, like you're still going to go on vacation, right? Like you set aside the money, so you're still going to go on vacation. I told you it's not a trick question, but it does just do that one job. That's it. So you got the vacation, you got the memories, you got the photos. Beautiful. But what if? What if you could do both? What if you could grow and compound and, buy yourself a death benefit and create this tax-free access to capital environment, etc., and still go on vacation? So I'm just saying, we're, like Nelson says in the book, we're overlooking, like you said, we're going to a microscope trying to look at how to get that investing dialed in perfectly, trying to make this little insignificant amount of our cash flow do something that's preposterous, really, while overlooking how much we're spending on cars and homes and everything else.
Take this. I don't want to offend anyone. When I say that, and when you just did that, like, I love the visual of the microscope that you're doing. It's like, you have to understand, if you took all of your income, regardless of like the dollar amount, all 100% of it, and compared it to like 1 or 2%, that's why I'm saying it's under a microscope. I'm not saying whether that's 100, 1,000, 10,000, or 100,000. That's the small number. That's not what I'm saying. Relative to the amount you made, how much potential do you have to capture? You could capture 100%. Now that's a strategy call, but what are you capturing? You're capturing 1, 5, maybe 10, maybe 20.
Well, Dave Ramsey says 15. Save 15, towards retirement. But which is bigger, the 15? People are expecting too much from the 15 or the 5 or the 2. They're expecting or they're told to expect too much is what it is, because that allows products to be sold and risks to be assumed by the client, etc. And they're told to expect too much from that, while just bleeding out interest dollars in the background for the things that they're financing every day and every month and every year.
That's a paradigm shift. I wanted to touch on something you mentioned. So going back to your not trick question, I think you could add the second not trick question is, okay, so we learned it did one job. You took it, you spent it on that guitar, vacations, and so on and so forth.
Snowboard. I got it in there.
That was a beautiful little alley-oop. Came in with a slam dunk.
I just soft beach ball now. Oh, man. The second question might be, okay, once you spend it and you get your snowboard, how much interest are you earning on those dollars? How much interest is the bank paying you on those dollars? 0. They're gone. And the snowboard company is not giving any interest either.
The principal's gone, and what it could have earned is gone also. Yeah.
Just getting people to think. I love how you said that, expect too much from whether it's 1%, 0%, or 20%. You're expecting too much from it. It's much easier to go from 20 to 80. If you could save 80%, you're going to dwarf whatever the 1, 2, 5, 20 will do.
Yeah. And let's just use the figure from Nelson's book. He says that the average American is spending 34.5% of every dollar on interest. Which just sounds, with some logic, with some reasoning, like he says, which just sounds more profitable for you. Trying to expect too much out of 5%, 10%, 15%, or what if you just kept a third of the cash flow that's going through your hands? All right, go ahead.
Yes, sir.
Yep.
I'm going to say this. So people will make that comparison, and traditional planners will try and do this. They'll say apples to apples. You have to do the same timeline, and it's got to be the same amount saved so we can compare the investment, right? They're trying to treat it like an investment. Like, no, that's part of the paradigm shift. On one hand, you save 1 to 15 or whatever percent. On the other, you save the 1 to 15 plus the 35.
Yeah.
So it's 50% versus your 15. Sorry, I win always. I win unless you're getting like 50% every year. You're never going to catch up. You're going to take on way too much risk to do that. You expect too much out of that to catch the simple answer. Just save all 50%.
You're right. That's the big picture answer, is that we're not saying don't invest. We're not saying don't launch a business. We're not saying don't diversify per se, but I would say that you can control and profit over the banking function in your life and keep more of the money that you're just splitting out. And when you do keep more of it, aren't you even better positioned to do more significant moves than 5%, 15%? What? Yeah, because you kept more. You can do both. They're not mutually exclusive, to make investments or to scale a business or to save, what otherwise would have been paid in interest on, the cars and the homes and the vacations, et cetera. Yeah, both. Both is always the best answer.
Here's a killer, dude, this is going to, oh man, I'm not done the one thought. So hold on, let me write this down. I don't want to lose this.
No, I've been doing the same thing. You're good.
All right, so 15. Okay, so I want to go back. What I originally was going to say is Michael Kitces. It has an S on the end. My apologies. I spelled it wrong last time.
Okay.
Kitces. Michael Kitces. Big time researcher, great platform, releases tons of white papers, has CFP. He teaches courses for the American College of Financial Services, releases continued education for CFP professionals, so on and so forth. Big time guy. He quoted several PhD holders, a doctorate in finance, and I forget what. There was 2 or 3, 4 PhD people working on this article that tried to rationalize the cost of paying an assets under management fee. And the complaint is, look how much that kills my balance in retirement. If the fee wasn't there, the balance might be $1 million. When the fee's there, maybe it's $700,000. So the real fee wasn't 2%, it was $300,000. And they're trying to work through this, and they come to the conclusion that, yeah, basically all capital has a cost. And so Michael Kitces writes out, it's yes, that's true, but then all spending, not just the advisory fee, what you spend on a latte, what you spend on, has an impact on your retirement. It's yes, that's the point. All capital has a cost. I thought it was funny that this bigwig guy in the industry with a bunch of PhD people finally came to the conclusion that all capital has a cost. If you spend it, it's gone. So is the interest or growth or whatever you want to call it is gone too. The potential is gone. You killed the seed and the future tree and the future seeds of that tree. It's all gone if you spend it. It's so that was very cool. My other thought, my epiphany here is people will try and compare an illustration. And most people just go straight to cash value. They're how much did I pay and how much cash value shows up? If we just took this idea we were just talking about, you could save 15% or you could save 50%. The original person was saving 15. If you were able to save 50 and had 15 available for loan that you can go do that investment, it's about the same. Now it's probably a little bit off because you couldn't refinance the other things, but it just occurred to me how hyper focused people get on the amount of cash value, the balance of the cash value, instead of how much you can do with the cash value. People want to compare it like an investment account. They like to see a lot of zeros because that somehow means, they're thinking through the personal financial lens that the balance is the end result instead of the corporate finance lens of cash flow. How much can we use this? The velocity of the money. How many times can we use this over and over and over? And really, if we control the terms, it's more not velocity, it's acceleration. Velocity squared is acceleration. We have control of other people's money and the terms. Yeah, that's
sounds like control and profitability.
Yeah, and so it's corporate finance compared to the people that just look at an illustration and say, see, this year that number's bigger, that one's better. And You didn't, you missed. You're looking at it through the personal finance lens. You're looking at it through, I call it the hostile environment. Hostile versus friendly. I think we went through that last time, but you're looking
Yep.
through that. I need a big balance. I need a big balance sheet. It's like, well, what if your balance sheet by like number looked small, but it spent really big? It's spent 3 times as large as it is. Maybe the spendable result is actually what you're looking for. Maybe you just want to see a large number because that makes you feel good. You got to make that decision. But most people that I talk to want spendable dollars.
You can't buy stuff with your feelings.
Yeah.
All right. So if I bulletize then that particular part of our conversation about personal finance versus corporate finance, you're saying that people in personal finance typically value a high net worth. And we're told that, and I'm not saying net worth's not something either. We're building our net worth by building a system of policies that we own and control and grow and scale and maximize over our lifetime. It's creating a net worth. And then corporate finance values cash flow. So not some static, at-risk, inaccessible number on a page, but rather this month, this is our cash flow. And we're going to use that cash flow to increase next month's and then next month's and then next month's. And again, remembering that a lot of these corporations, just if we look at them, they've been around longer than us, probably outlast our individual lifespans. What if we began to think long range? What if we began as people in our personal finance to value cash flow instead of just net worth? Again, I think those go hand in hand. You know, the more you scale your cash flow by creating a private banking system, the way that we would encourage people to think about by having whole life policies from mutual companies that pay dividends, that allows you to grow and scale your cash flow over your lifetime in a guaranteed fashion. And it eventually still culminates in a tax-free, income tax-free transfer of wealth to the next generation, which is essentially a big windfall, you know, of net worth to the next generation at the same time. You can do both. Is that a fair recap?
And I like how you use the word static. For accountants, a balance sheet is a snapshot. It's a snapshot in time. It's ironic. It's just like a bench, you read the thermometer. It's just how are we doing? After this year, how are we doing?
I like that. A thermometer. Yeah, because it's just because you didn't have a fever yesterday doesn't mean you won't have one today. Just because you had $1 million yesterday doesn't mean you won't have, you know, a third of that evaporate by today.
It's a snapshot. And where the net worth really, it results in capital. The difference between assets and liabilities is the equity. That's the capital that owners get to choose at the end of the year. What do we want to do with it? Keep it in the business or extract it? But that came from the income. So people focus on something that's meant to be like a status update, the balance sheet, instead of the actual engine of the machine, which is the income. The income is where the net worth comes from. It all settles back in capital.
So that was actually the tactical
earnings.
answer I was looking for earlier when I asked you, what do you think is the biggest contributor, you know, for the lay person? It's their income. Their income could be the engine that you're describing for.
Yeah.
Oh yeah. It's the income can either, it gets burned, as we talked about before, you use it on liabilities or expenses and it's gone. Or it can be used, collateralized, buy an asset that pays the expenses, that net result, there's a residual, that's the retained earnings. The retained earnings is the net, like it goes to the net worth. That's what that is. Yeah, it's I think if you take an accountant's view of this, if you take an accountant's view of personal finance or a corporation's view of finance, you'll improve your financial standing head and shoulders compared to, again, you go back to your bullet points or even just like the personal finance, as you get paid, you pay everyone else. You basically have to work with what's left, and you're expecting a lot out of that. Whatever percent that is, you're expecting way too much out of that. It requires you in that environment to take on more variability of returns or risk to get outsized returns so you can hit a number on your balance sheet when you retire. Like more and more, I mean, the same guy, Michael Kitces, there's Wade Fowle is a big guy in the retirement space, another PhD. There's Ernst & Young was commissioned to put out a survey. We just kind of reviewed that, where they realized actuarial products are perfect for providing the income that we need on a guaranteed basis, a contractual basis that can support your lifestyle more so than just investments. They play together better than they play apart. But if you had to choose, I don't know. I would rather have a business and actuarial products than just mutual funds.
For sure.
Right? If you have, like right now, realize you kind of are a business. If you're a W-2 employee, if you're a professional employee, you get a paycheck. Someone else is paying you. You're kind of your family's business. You're the income earner.
Mm-hmm.
You're the engine that's pulling in the money that you have to decide where it goes. Now, there's some unfair advantages where they take taxes out first, so you don't see 100%. You might see 75, 80% of your actual income. But with that you could still make good decisions on where that should go. If you give that away and you're left with that 10 or 15 we were talking about earlier, it's like it gets really difficult to make a lot of progress. You're banking on time and hoping the variability of returns, the sequence of returns lines up so you hit a number that you hopefully can support you for the remainder of your life. I don't know. In that scenario, I don't like just hoping that it's going to happen. I like more control. I like flexibility.
No.
I like simplicity.
For sure. And that's what I would say is, Nash says in the book to, if you're in a business or a career job or whatever it is, the next thing that you should consider is being in the business of financing that business. So if there's a household or an individual out there that's earning from their career income, the simplest, most profitable way for them to increase what it is that they're doing is to become their own banker, because they do then begin to control the banking function, which allows them to have access to compounding capital over their whole lifetime for insert the blank. They could still make investments if they want to make investments, but now they've been more efficient with their dollars. They can begin financing the cars and the homes and those other things. They can launch a business because they have been proactively amassing capital in a place that they control, and they don't have to wait till they're 59 and a half and all these different things. It is simple. It is profitable. It is doable. It's as straightforward as just wrapping your mind around the concept that you could be your own banker.
Well, so let's take that person, the person who's starting a bit. Like, what are the statistics on how many new businesses fail? It's extraordinary.
Sure.
1 year, 3 year, 5 year. It's extraordinary how many fail. Why do they fail? Access to capital, mismanagement of cash flow. That's it.
It's hard to run a business under if it's still got money.
Exactly. So imagine if cash flow is the lifeblood of the business, and you're getting your cash flow from a bank who controls the terms of the cash flow. When things get a little rocky, they tighten up the belt on you. But what if you were the bank and you could do the opposite and give yourself grace to get through the rocky time? All of a sudden, instead of failing the business, you stay in business for the 3, 4, 6, 8 months to get through that, and you're better off on the other side. It's control. You're taking risk off the table if you control financing. If you control the terms of your financing, the risk goes way down. And I think that that adds into that freedom element I was talking about. That gives people the sense of confidence to actually try that business. If they knew, they drew up their own plan and they're like, here's my checkpoint. If I can't do this by that date, I'll call it. But for 5 years, I'm going to try it, and I'm going to control the financing, so nothing external gets in my way. It's really just, was this a good idea or not? They have all the confidence in the world to do it. If they have to beg 5 different banks and have to pledge personal assets and have to jump through hoops, like, not only is that annoying, it's incredibly intrusive. Like, maybe some people just like privacy, to say, I don't want you asking. I'm going to use it the way I see fit. I don't need to tell
Yep.
you. It's like, now, I think that's better. I think you, unique person with your capital, no one has any business knowing that. If you go to sign up for a bank account or a brokerage account or a retirement account, there are so many questions like, where'd this money come from? Where is it going? You know, what's your net worth? Give us your balance sheet. We need 2 years of taxes to confirm all this. It's incredible. Some people just don't want the headache. Nelson would call it Mickey Mouse paperwork. But if you can take that out of your life, that's part of the cost of acquisition. You take that out of your life. You take the when times get bad, banks tighten up credit standards. You take that risk out of your life. Like, my goodness, how peaceful life becomes. What's that worth? What's
A
the
lot.
economic value of peace of mind? Where does that show up on your spreadsheets when you're comparing all this? Even if it was identical, everything you could match up. And this had to do with, you're in bed with the IRS, banks, brokerage that require all this paperwork. It's like, I'll take the easy route, the simple route every day. That's worth a lot to me. I don't know. Maybe you like all that.
No.
No, I love what you're describing. No, I just want to be able to pay the premium that I want to pay into a private system of property that I own, have access, guaranteed contractual access to that capital, know that it's going to provide a legacy day one, by paying a premium, by buying whole life insurance day one. Worst case scenario happens, that's the day I graduate, pay out to my family, right? But every day that I'm alive, which is the more likely scenario, it just gets better. On autopilot, guaranteed, it's just going to get better. And then if I use it like a private banking system and I become more profitable because of my behavior, because I start, incorporating this corporate way of, appreciating cash value while still maintaining a respect for net worth, because I've already checked that box with the death benefit, et cetera, as well. And I'm making policy loans for the things that we were going to do anyway, like take a vacation or like do this or that or the other. Yeah, no, it is everything that you just described, for sure. Simple, profitable, you're keeping control. It's a peaceful way of life. It's all of that. It's all of that. Joe, how would you like to? I'm gonna give you the time. I mean, I'm not even looking at it. So you can check on your end. I've written down half a dozen themes and topics that we started out with that we haven't even had a chance to circle back. And as always, I'm painting the picture. I want to be able to have more conversations with you. Is there anything else that you'd like to be able to touch on where we've gone in this particular conversation today? I mean, what I hope that people are taking away from this is that if they're a business owner, that they appreciate their business more and the opportunity that's available to them if they become their own bankers in their business. For the employee out there who's just building a career and a home and a family and all that type of thing, it's the most simple thing to add one step to what you're already doing and become your own banker there. More profitable, more control, more peace. But I want to give that to you for how you'd like to wrap this up or anything that you'd like to add. I'm open to all of it.
I was going to add, like, towards the tail end of that, you had mentioned, or I was mentioning different account types. And a lot of people will think to themselves, well, I could just use a bank account. and there's or their investment account. And there's ways you can mimic the infinite banking concept, the process of becoming your own banker. But you can't totally achieve it without the help of a bank. Like you have to still take your investment account and go to a bank and say, I pledge this as collateral, give me a line of credit. And you can mimic some of the benefits of this with a whole life policy. Or you can go to your bank account and say, I pledge my CD or what have you, give me a line of credit against that. And you can get close, but there isn't anything that is self-sustaining, that doesn't need a bank, meaning you're in control of the terms. None of them can replicate that.
Right. Asking for permission.
Asking for permission. The other thing I thought as I was saying that was so many people think when they put 100, 1,000, 10, whatever thousands of dollars in their bank account, they own the dollars in their bank account. Like, man, oh man, I think we've said it in one of the other conversations. If you read the fine print and knew you own zero, like the serial code on the dollars you put in there, they're not in like the Jesse folder, like waiting for Jesse to come and get those dollars.
Yep.
You are a creditor to the bank. They promise that when you come in within a reasonable period of time, they'll be able to get you the equivalent of your account balance in cash.
You did. You said it was an
That's very
IOU last
different.
time.
It's
Yep.
an IOU, right? The same with the shares in your investment account. So like you don't even own, like you have totally given up ownership of those things. You don't own the shares in your account. Some like try and call them and say, I'd like to receive my shares of Apple. They'll say, well, you can't because they're in street name. That means they're in the custodian's name, the broker dealer's name, so they can swap them around. Man,
Let me play devil's advocate
I
right there. So, because some people who are combatants of infinite banking could easily say right there, and they would be right, I'll point out ahead of time, that when you pay premium, that money's not yours anymore either. So again, they would be right. When you pay premiums, that is the insurance company's money. But I would also follow that up by asking, but what do you have? What is yours? And it's really simple. I think its simplicity is so powerful. You got a contract. You're a contract owner. You know, legally binding, unilateral contract. That's what you own. So you're right. If you got money in a stock, if you got money at the bank, if you got money even with an insurance company, it's not yours anymore. But what is it that you do have with a bank? You got IOUs. You got an IOU, you know, backed by an FDIC that doesn't have any money. So take that for what it's worth. You know, but do insurance companies have money? Because they don't operate like banks do. Yeah, they've actually got the money, right? And you've got that legally binding contract that says you got a death benefit, you got a cash value, you stand to earn dividends. That doesn't go away for your whole lifetime.
So the difference, like playing off that, the difference will be the insurance company does have a folder with a bunch of bonds with Jesse's name on it. That's the value of that bond portfolio that supports that's earmarked for Jesse. That's what that's the value of your cash value. So your cash value is going up. They have to, like the risk is on them. It's separate, meaning you don't, the value is not going up and down on your end. They have to meet the growth. And the growth has to equal the death benefit way out in the future. So for your intended purposes, you don't care what they have to do. But on the insurance side, they're not printing money. They have to go out and make the returns to hit that target. And when they overachieve, that's what your dividend comes back. Like they return at the end of the year, they say
for a very long time.
For a very long time, they say, oh, we did better than we thought. So Jesse, what would you like to do? Would you like a one-time adjustment in your death benefit so the premium dollars you paid equal the correct amount of death benefit? Or Would you like to use the premium dollars and pay next year's? So you pay a smaller premium next year so we can reconcile our books. Or do you want it in cash? There's a couple other options, but at the end of the year, the right answer is let me take that one-time boost because I know that one-time boost means the next year everything should be bigger. And the next year it should be bigger. That's part of the
And that
that's part
future
of the
dividends will
compounding.
be bigger also.
Potentially. But like that's the idea is like the dividend is them reconciling their books to say you paid this much premium that was supposed to pay for this much death benefit. You only have this much death benefit. What do you want to do? Do you want the right amount of death benefit? Do you want to pay less next year so we can reconcile our books? The books need to line up at the end of the year.
Sure.
Right? So you have to let us know what you want to do. Buy PUAs, which, I mean, if you want to go into I don't want to, man, we can go for hours here. Like I was going to say, if you go
I know.
becoming your own banker, so I'll quote it. I don't need to bring it up, but it was on page, if anyone has the book, 44, I believe it is. Yes. 44.
Good, because that's kind of where we started at, even
Um,
though I feel like we've covered a lot of ground since we were looking at page 45 and the CD versus the policy and everything.
Well, let me read this. It's the addendum on page 44. It says, note that the illustration, so on and so forth, does not show any policy loans to make car purchases. The purchases are made by use of dividend withdrawals. Now, if I were in the insurance business, meaning he was not when he wrote the book, just caveat there. If I were still in the insurance business, I would never suggest a client do it this way. I would recommend policy loans to buy the cars.
Mm-hmm.
Why did he do this? It's like, well, you know, why are you demonstrating dividend surrenders? The simple answer is because many people, when they see the word loan, their brain goes to a deep freeze. Loan means something bad, something I should not do. So I just wanted to demonstrate that the concept could be done this way for the benefit of those that have that problem with the word loan. Wow. So he did it in an inefficient way. People don't realize the equipment financing is inefficient. It's very conservative the way he did that. The CDs example, the CD sisters example, inefficient. Still blows it out of the water. It's so abundantly clear which option you should choose. Like he could do it in an inefficient option.
Yeah, not optimizing how it could be done using infinite banking still beats conventional finance.
Comfortably.
Even when infinite banking's done, yeah.
Like oh man, that's worth, I mean, we can go through that example. We probably need another podcast to do that.
Well, and it's good. And I've made mistakes, and you've probably made mistakes, right? Like, and that's the grace that you have by being in that position of being your own bankers. Even if you've made mistakes or been inefficient, etc., it still beats conventional finance head over heels.
Let's take that back. Your words. I love this. You're expecting too much out of the 15%. In this environment, you can mess up and you will be fine. It's okay. There's a lot of people on the internet promoting what they think is infinite banking, the infinite banking concept, and it's not. But it's like the infinite banking concept, it's like this umbrella that can still mask the sins of the people that are telling it wrong. Even doing it wrong will still put you in a better position, better financial situation than traditional financial planning.
Still, whereas while not saying that it does matter, you know, what type of product you have and what companies it with and who's helping you, who do you have in your corner, you know, your agent, your advisor, all still important and relevant. I'm with you. I'm tracking with you.
Like that comes from, what's it? I think James Nethery, maybe Ryan Griggs. You know, when you understand what's going on, the details don't matter. If you don't understand, the details still don't matter. You're getting lost in the weeds. You're so lost in you're thinking like like the ETF and mutual fund world. You have to like penny pinch, maximize these little dollars. It's like, man, you're in a different world. It's okay. That's the wild part. If you bought a policy from any of the top five mutual companies that lean into this concept, that don't reject this concept, any of them, you will be fine. Could it be better? Sure. But do we know for a fact? It's like, that wouldn't be the reason I would do this or not. Like, oh man, this company changed their contract a little bit, so it's slightly less favorable to me. I guess I should just abandon ship. Like, no, this is so abundantly clear. Once you understand it, once you understand how to value this, man, it's night and day difference. The little details. This one has a slightly higher dividend rate. That one has, oh, they're higher Comdex. This one, like, it's noise. It's just noise. You're just like, the point is, you need to do this versus not do this. That's the decision.
Yep, I'm with you. That's where I say we wrap this one up. Again, while I'm extending, we'll put our calendars together if you're willing. I don't want people to think that you're being flippant with your time either. It's a big deal for me to be able to have these kinds of conversations with you, and for everybody that's in the audience as well. And you can find Joe 10thstreetcapital.com. Yeah. And I'll make sure to put that in the show notes as always. But man, I always appreciate our conversation. Any last parting words?
No. I think it's funny. I blocked off a lot of extra time because we tend to go over. So, but
I know how we've done.
But yeah, no.
But it's me trying to be respectful of your time too, so that you'll feel good about coming on the next time that I ask you to, which is what I want.
I appreciate it, and I always do. It's always good just to have a good conversation. I have no paper. We're not running off like pre-script here.
Yep. I just had my book handy because I know you're going to point to pages, and I had my paper and pen so I could write down my thoughts. No, exactly. And I love it. And I don't mind, and I've been real organized on my channel as far as I've tried to categorize, certain things that I think, I appreciate being categorized, right? But I do like this here where I can just come in and hear your thoughts and hear your perspective, and everybody else can, and then I can ask questions back and give mine and let the iron sharpen the iron. And I do appreciate it, man. I'm definitely looking forward to our next time.
Yeah, the only parting advice would be, anyone listening, read with a scholarly mind. You got to look past the words, the funny phrasings, really digest what's in this book. Spend time, research, ask questions. I think I said read it 4 times. That's the book. Get your copy from Jesse.
Yeah, and
if you don't know why he would say read it 4 times, just make sure to check out that first episode that we recorded together. If you're curious about the snowboard comments that keep coming up, just all right, Joe, you have a good day, man.
Appreciate it. You too.